Welcome to this webinar on U.S. and EU regulatory battles on commodity price volatility. My name is Karen Hansen-Kuhn. I'm International Program Director at the Institute for Agriculture and Trade Policy. IATP works locally and globally to promote fair and sustainable food, farm, and trade systems. A little more than a year ago, many of us were celebrating the passage of DoddFrank, the first U.S. legislation in many years to attempt to rein in excessive speculation on commodity markets. A few months later, we were encouraged by France's announcement that it would push the G20 to address this issue, both as it related to food prices and, more broadly, on commodity price volatility. These were exciting announcements, but of course the devil is in the details and the implementation. So today we'll hear about recent developments in the rulemaking process for DoddFrank in the United States, what's been happening in the European Union, and what the G20 has said so far on commodity speculation. Before we get started, I'd like to run over a couple of technical questions. First, we are recording this webinar, so we can send you a link with the recording and the slides later. We'll also be posting those to our website. Also, we'll be taking questions from the audience today from our two panelists after they've both finished their presentations. You can submit your questions to the panelists at any time during the webinar by using the question panel on your screen. Just type in your question and hit send. We'll review the questions as they come in, and Steve and Marcus will respond to as many of them as time allows. We're going to start with a presentation by Steve Supan. Steve is a senior policy analyst at IATP, and he'll be talking about developments in U.S. regulations and at the G20. Then Marcus Henn will speak. Marcus is a project officer on financial markets at WEED, World Economy, Ecology and Development, a German NGO, and he will address recent changes in EU policy. So we'll start with Steve.
Thank you, Karen. I'd like to start with an overview, and the overview will consist first of a quick trip through 4 charts to show some data about what is to be regulated, and also point in the data to a major issue that has thus far escaped rulemaking both in the United States and in the G20 considerations, namely commodity index funds. Then we lead off with the G20 recommendations and commitments because they are the common framework for harmonization of U.S. and EU rules. These commitments are far from being fulfilled. On October 18th, the Commodity Futures Trading Commission approved a position limit rule that's both flawed and noteworthy. It is far from implementation. The specific formula of the position limit rule, furthermore, is part of a complex legal strategy to defend the Dodd-Frank derivatives legislation against the Wall Street challenge at the U.S. Supreme Court. And we'll discuss a bit of the logic behind that defense. Then, between 90 and 95% of all derivatives are traded in U.S. and EU markets. The CFTC and the European Commission have a regulatory cooperation program that will face several challenges to harmonize EU legislation and the requirements of Dodd-Frank. The unregulated derivatives market is estimated to be about 7 times the size of the regulated equities, bonds, and commodity markets in notional value, that is the face value of contracts. And here we see the $600 trillion charted from Bank of International Settlements figures by Sean Cota of the Petroleum Marketers Association of America. $300 trillion of that is in U.S. derivatives markets, compared to an $82 trillion global bond market and a $44 trillion equity market. The commodity derivatives market is appreciably smaller, perhaps a little bit less than 1% of the global derivatives market. Here in a chart by Professor Gayatri Ghosh in a 2010 study for the World Development Movement, we see that the notional value of commodity derivatives at the height of the bubble in 2008 approached about $12.4 trillion. And what is particularly significant and useful in this chart is that we can see how there is a rough correlation between the primary commodity price index as tracked by the International Monetary Fund and the value of the over-the-counter futures contracts. This chart shows in a very rough form what has since been confirmed in detail, and that is that the over-the-counter money is a big driver of commodity prices and price trends. In this chart by a study in the Federal Reserve Bank of St. Louis review, there are two main virtues. Here, this chart tracks the trajectory of the bubble, the bursting of the bubble, and the reinflation of commodity investments invested long through the index funds. Despite the excellent work of Michael Masters and Adam White to show the role played by commodity index funds in inflating and then deflating agricultural and energy derivatives prices, DoddFrank does not discipline index funds as a trading instrument, one that correlates in the index fund formula otherwise uncorrelated markets such as oil and wheat, in which the oil essentially is driving the wheat and other smaller agricultural components of the index fund. Finally, the way it charts, this from Better Markets, showing the change in composition of U.S. markets here prior to the deregulation of 2000. We have a market dominated by commercial hedgers, that is, actual users of commodities, with traditional speculators also, like commercial hedgers, investing on the basis of supply and demand and other fundamentals. By 2006, the index fund investors had displaced a good part of the commercial hedgers who could no longer afford to use risk management tools in a highly volatile market. The commercial hedgers provide sufficient liquidity for what the economists call adequate speculation. The index fund investors are indifferent to fundamentals. Their weight of money will drive prices up and down, and unimpeded by enforced position limits, index funds provide excessive liquidity for excessive speculation. Now we turn to the G20. In September 2009, the G20 heads of state committed to moving, quote, standardized OTC derivatives to exchanges or electronic trading platforms as appropriate, unquote, by the end of 2012. This commitment, if implemented, would make more transparent the universe of bilateral over-the-counter trades that is a black hole for price information. The heads of state also committed to clearing over-the-counter trades through centralized platforms. Clearing, in essence, is a series of good credit management practices to prevent counterparties from defaulting on their obligations. The default cascade in 2008 was prevented only with taxpayer bailouts of the too big to fail financial institutions. However, financial industry analysts have sought large exemptions from these commitments. They argue that banks customize OTC derivatives for their clients and therefore should be exempt from putting those derivatives on exchanges and paying the higher exchange costs of clearing and collateral margin. In September, the Financial Stability Board advised the G20 ministers that the heads of state commitments were very unlikely to be met by the end of 2012, and a lot of this lack of accomplishment is due to the resistance of the financial industry. The G20 finance and agricultural ministers have tried to find ways to implement the heads of state commitment to moderate commodity price volatility. They have focused on improving data collection about the physical commodities that are the underlying assets of the derivatives. The Joint Operational Data Initiatives for Gas and Oil and the Agricultural Market Information System are the major proposed G20 solutions to the lack of comprehensive and reliable data about stocks of physical commodities. However, as the Brazilian finance minister has pointed out, the private companies that own or control these stocks will be very reluctant to share information about them. Furthermore, some stocks, such as those held by China, are considered to be national security secrets, so it is rather doubtful that progress can be made on improving information about physical stocks. The October 14th to 15th meeting of the G20 finance ministers welcomed and endorsed further work on earlier commodity initiatives, and perhaps the most significant part of the October 15th communique as regards commodity derivatives is the Minister's endorsement of the September report of the International Organization of Securities Commission's Principles for the Regulation and Supervision of Commodity Derivatives Markets. Nevertheless, this document is worth a read despite its compromises because it represents consensus among national regulators and exchange officials. Finally, we have to note that the G20 ministers had nothing to say about a Financial Stability Board warning in April 2011 about the explosion of synthetic exchange-traded funds. In so-called plain vanilla ETFs, such as mutual funds, investors own shares and not derivatives of the components in the fund. Commodity derivative ETFs, despite their name, are traded over the counter, which the board found disquieting. Now I'd like to move quickly to Dodd-Frank. On October 18th, the CFTC commissioners voted 3-2 for a position limit rule that is authorized by Dodd-Frank. The rule limits the percentage of each of 28 rule reference commodity contracts that can be held by any one entity during a given trading period. The purpose of the rule is to prevent excessive speculation, price distortion, and disorderly markets. IATP and several other NGOs and industry organizations criticized the rule, stating that the positions were set too high to prevent excessive speculation. Insofar as 19 of the 28 rule reference contracts are agricultural, IATP believes that the rule provides particularly ample opportunity for excessive speculation and the injection of non-fundamental factor volatility into agricultural prices. However, and this is a big however, Wall Street has begun to challenge Dodd-Frank rulemaking in court. CFTC commissioners representing Wall Street questioned the CFTC staff as if it were a pre-trial deposition. The CFTC staff proposed formulations are part of a complex legal strategy to prevent the Dodd-Frank legislation from being overturned by the U.S. Court of Appeals in Washington, D.C., and eventually by the Supreme Court. The position formulas for all rule-restricted contracts are based on existing position limits for 9 so-called legacy contracts in corn, soybeans, wheat, and cotton. They are called legacy contracts because those position limits have been in effect for more than 30 years without legal challenge, according to Reuters commodity analyst John Kemp. Whether these legacy-based position limits will survive the scrutiny of the courts is uncertain. However, appealing to legal precedent by setting the position limits at legacy levels is part of what I believe is a necessary and anguished CFTC defense. The components of the position limit rule will not be enforceable until the Commission agrees on how to define the instruments and market participants to whom the position limits will apply, and this agreement is unlikely to come before 2013. Furthermore, the positions can only be applied effectively if the CFTC has the personnel and computer infrastructure to compile and analyze the position data. Those opposed to Dodd-Frank are trying to ensure that the CFTC does not have these resources. Among the myriad exemptions to Dodd-Frank rulemaking sought by Wall Street is one that would allow major swaps dealers such as Goldman Sachs and Morgan Stanley to benefit from the same exemptions, including exemptions from position limits that apply to their clients who are bona fide hedgers managing commodity risk. The International Swaps and Derivatives Association has proposed that the CFTC should define commercial risk to include all financial risk carried by the banks. Such a definition would allow the banks that are counterparties to a trade to receive the exemption from position limits that their commercial hedging counterparties would receive. Whether such a broad exemption would be allowed is yet to be determined in the CFTC rulemaking. Now, challenges to U.S. and EU regulatory harmonization and cooperation. The Dodd-Frank Act requires that firms registered with foreign boards of trade and wishing to access U.S. markets must be subject to a regulatory regime that is comparable to that authorized by Dodd-Frank. And because of differences in how commodities are regulated in the United States and Europe, determining this comparability in a revision of the existing transatlantic memorandum of understanding will not be easy. From a Dodd-Frank viewpoint, here are a few features of those differences. In the spring of 2010, the French government proposed that the European Commission draft legislation for European Commodity Regulatory Authority with powers similar to those of the CFTC. Several governments, led by the United Kingdom, strongly opposed this proposal as an affront to national regulatory authorities. Instead, the government supported the creation of a European Securities and Markets Authority, ESMA, that would coordinate financial market data collection among EU member state governments. ESMA has an initial staff of 55 persons that is expected to grow to 300 by 2015, in contrast to the understaffed CFTC of more than 800 persons. But ESMA staff will cover derivatives not just in commodities, but in all asset classes, including equities, bonds, interest rates, and exchange rates. U.S. regulatory harmonization negotiators will have to verify ESMA's ability to gather, verify, and analyze commodity derivatives data from EU member states. This is a big challenge for both the U.S. and the EU. The present CFTC Advisory Committee structure assumes that only the largest banks, hedge funds, and exchanges should have representatives on the Global Markets Advisory Committee that advises the International Office of the CFTC. It is this office which negotiates the Memorandum of Understanding. IATP strongly believes that this committee must include representatives of the commercial hedgers who will be affected by the Memorandum of Understanding. To have robust international regulatory cooperation will require not just the participation of regulators and banks, but also of commodity end users. Finally, perhaps the strangest aspect of the US and EU regulatory battles to make dark markets transparent and orderly is the rhetorical appeal by bank lobbyists to national interests. A July 21st General Accountability Office report on the Federal Reserve emergency loans to the global entities showed that $16 trillion went to the US and EU subsidies of US and EU headquartered global banking entities. Just as trading and bailouts do not stop at the borders, neither should regulation to prevent another financial industry crisis that will afflict severely the real economy worldwide. Thank you very much for your attention, and I look forward to your questions.
Thanks, Steve. That was really interesting. So next we'll have Marcus Hent talking about developments in the European Union.
Yeah, thank you very much, Karen. I want to start with showing a comparison between the EU and the US wheat markets to give you an idea why the commodity derivatives markets are different between US and EU. On the left side, the blue column, you can see these are the national wheat harvests, and on the right side you see the most important wheat exchange, Chicago or Paris in the EU, and you can see that there's a big difference between these two figures. Which means that in the EU you don't have this kind of inflation of the derivatives markets as we have experienced it in the last years in the US. One background reason for this is that in the EU for a long time parts of the agriculture markets have been strongly regulated by the Common Agricultural Policy of the EU, and this is now being liberalized, and that's why we can experience a growth, a big growth in derivatives markets in the EU. However, still, as you can see, there's a big difference in the amounts. This also means that the regulation of these markets is far from the US, and there's a big discussion now going on which is not comparable to the US discussion, where we have much more experience with commodity derivatives markets. As you can see here, there's Michel Barnier and Nicolas Sarkozy. Michel Barnier is the Commissioner for Internal Market and Services in the European Union, and Sarkozy, the French president, they have both uttered strong concerns about food speculation, saying that it's a scandal and that it has to be regulated. So there is a momentum in the EU to have strong regulation. However, this is of course not anonymous. There are other voices like the UK or other countries which are not so strong on this. What they do now is that they have a kind of piecemeal regulation. So you don't have this kind of DoddFrank big law which regulates all regarding commodity markets, but there's a lot of laws which are affected, and especially for the US people it's important to know that there are two different laws in the EU. One is a so-called regulation, which is a law which is directly applicable and enforceable throughout the European Union. And on the other hand you have the so-called directives, which are kind of framework law which has to be implemented by member states in their national laws, which of course means that it also takes more time till they are enforceable. To show you now what this means for the regulation regarding commodity derivatives, I want to begin with the two directives which are in force. The one is the Markets and Financial Instruments Directive, and the other one is the so-called Market Abuse Directive. And the MiFID, the Markets and Financial Instruments Directive, will now be revised, and there will be a new kind of regulation, which is the Markets and Financial Instruments Regulation, which means that it is more enforceable than the directive. And these proposals have been released some days ago on the 20th of October, and given the complicated process in the European Union, it will take at least till summer 2012, maybe even autumn, till there is a final decision on this. So we just have some proposals by the European Commission at the moment. The same is with the Market Abuse Directive. There will be a revision of the existing directive. However, big parts of this Market Abuse Regulation will be moved to a regulation, and this means also a stronger enforcement for the European Union. And additionally, we have a new regulation which covers especially OTC derivatives markets. It's a so-called European Markets Infrastructure Regulation. This one is at a later stage in the regulatory process and will be decided soon, possibly in November or December, by the Parliament and the Council, which have to finalize all laws in the European Union. Now going to some details of these regulations and directives, I want to begin with a general scope of the rules, and the most important ones from the Markets and Financial Instruments laws are that, firstly, they are generally applicable to investment firms and regulated markets and credit institutions. And there's one important thing regarding commodity markets, that there was an exemption for commodity traders, and this one shall be deleted, which means that they have to face more rules than before regarding their business. There are some minor exemptions now still left, which are for dealing on account under certain circumstances, and also for ancillary activities in commodity derivatives markets. However, this big exemption has been deleted, and there's a big discussion now going on, for example, for energy traders who fear these new kind of rules. Secondly, there is a new kind of trading facility introduced. Before there was just so-called regulated markets like organized exchanges and so-called multilateral trading facilities. However, there was a movement to the OTC markets, and that's why now the Commission has decided to propose so-called organized trading facilities, which are, for example, swap execution facilities to cover this OTC markets and dark pool trading. Additionally, there are new rules which should cover the algorithmic trading and especially high-frequency trading. So all entities which apply these kind of algorithms have to face higher requirements regarding their risk controls and, for example, have trading thresholds and limits for executing their orders. And at the same time, there are also higher requirements for the regulated markets which apply to the algorithmic trading. Finally, regarding the regulation on the OTC derivatives, there's an important scope which is similar to the US logic of the bona fide hedge exceptions maybe. There is a general rule that it applies to financial counterparties, which means all kind of financial entities in the EU, and the rest they say is just non-financial counterparties which are somehow thought to be the hedgers in the markets. The EMIR, to come to the main content of this EMIR regulation, is the clearing. So it will introduce central counterparty clearing for eligible derivatives, meaning that they have to be on organized trading facilities, the central counterparty clearing facilities, if they are said to be eligible. And what is eligible is defined by a combined so-called bottom-up and top-down approach, which means that the trading venues can either apply for clearing eligibility, or the authorities can say that a certain contract has to be cleared top-down. The remaining OTC trades, according to the EMIR regulation, shall also face high requirements regarding, for example, margin and collateral. However, the details, of course, are not so clear. They have to be also made by the authorities later on. Very important is that the mentioned non-financial counterparties are generally exempted for their hedging activity for anything that is related to their commercial business. however, if they do something which is also a kind of financial activity, so have some derivatives which are not related to their commercial business, they also have to face maybe clearing requirements, and there will be a certain threshold to define this, which is unclear yet. The next issue, which is a big thing in the EU now, is transparency. As Steve said, there is not much transparency compared to the US at the moment, and this is the reason why there's a lot of requirements now improving the transparency in the EU. The first thing is that for commodity markets, there will be a real-time reporting to venues, and the venues have to publish weekly reports according to the class of traders, for example, like credit institutions or investment funds or commercial undertakings, which might be a similar thing as compared to the US classification, but it looks also a little bit different, and it remains to be seen if this is comparable regarding the data compared to the US breakdown in the CFTC reports. The second thing is that there's improved pre- and post-trade transparency for all trading venues, so for the regulated markets, the multilateral trading facilities and the organized trading facilities, and also for a part of the OTC trading, which is undertaken by so-called systemic internalizers, and also for exchange-traded funds. And so they have to have better transparency on things like the quotes, the prices, the volumes, and execution times. At the same time, there's also real-time reporting from the trading venues to the authorities, so they have to provide information, amongst others, on the names, the numbers, quantities, execution time, prices, and other stuff, client ID designations, for example, and algorithms and firms, which will provide the authorities with a lot of data to control the markets. Finally, there's another transparency requirement in the EMIR regulation, because apart from the clearing, also all the derivatives trades have to be reported to trade repositories, also the whole OTC trading, and these so-called trade repositories shall then regularly publish aggregate positions. The next issue, which is of course a very important one, is the position and price limits. So we have in the MiFID regulation a requirement which says that all trading venues have to have rules for the number of contracts which are entered over a specific period of time by a market participant. However, there's one exception or one additional rule which says you can also have so-called alternative arrangements with equivalent effect instead of position limits. To us, it remains very unclear what exactly is behind this alternative arrangements, and we have also criticized this as NGOs, because we do not know if this opens a huge loophole for trading venues to circumvent these position limits. The reasoning of the position limits in the EU is, as according to the law, that it should support liquidity or support the orderly pricing on settlement conditions in the markets, or to prevent market abuse. So these three reasons are given for position limits. This means it's not comparable to the US limits, where you also have this excessive speculation as one reason to implement limits. The Commission, the European, has the power to prescribe position limits. That means that it can also make some common position limits throughout the European Union. And the national authorities are not normally allowed to have higher position limits. However, in exceptional cases and with justifications, they can also apply higher limits. But the general rule seems to be that the Commission will apply the limits. How strong the Commission will advise on limits remains to be seen when the laws would be enforced. At the same time, there's another rule which says that the European Markets, Securities and Markets Authority, the so-called ESMA, which is a new regulatory body since 2011, has to ensure a coherent approach to position limits. So there's an additional way to reach common limits throughout the European Union. However, the exact details of these common limits also remain to be seen. Finally, there's a new rule on price limits, which do not exist so far in the European Union, which is that the regulated markets, that means not all the markets but only the regulated markets, need to have price limits which reject the orders that exceed these predefined volume or price thresholds or are erroneous. And there are also requirements for circuit breakers, which means that they have to halt the trading if there's a significant price movement in the market. Finally, I want to come to some general points on the supervision and enforcement. First, there is a shared supervision between the EU and the member states. This process is something which is always a big struggle in the European Union, how far the EU has powers and how far the member states keep their powers that they have at the moment. And it seems at the moment, according to the proposals, that there will be a shared supervision, which means that the EU, namely the ESMA, the Markets Authority, and the European Commission, have very strong measures, very strong capabilities, but at the same time the member states also remain capable of regulating the markets. However, as Steve already mentioned, there is no CFTC like specialized commodity derivatives body, and also the ESMA, as far as we can see, will be not very strong regarding commodity derivatives. However, of course, it might be that they will set up some kind of special branch within the ESMA. Secondly, the most important measures like prohibitions or other measures against traders can be taken both by the ESMA and the member states, so they both in general have the ability, and there are several preconditions which I cannot go into now. However, both in general have the ability. Finally, there is the mentioned market abuse regulation and directive. This is dealing in general with market abuse practices regarding prices, for example, and especially with insider dealing. And so far, this market abuse directive only applied mainly to the financial markets, and now the Commission has decided to apply this also to the commodity spot markets. So not only commodity derivatives, but also the commodity spot markets insofar as they have an effect on the derivatives markets. Secondly, they will also include all OTC trading, which was not the case before. And finally, they will also include especially algorithmic and high-frequency trading in order to cope with these new kind of threats that this kind of trading poses to the markets. That's my information. Thank you for your attention.
Thanks very much, Marcus. We have a couple of questions, a few questions already. I would encourage anyone in the audience to type your questions into the chat function, and I will pass them on to the panelists. We'll start with a question that I think is for Steve, which is, were the legacy limits for agricultural commodities too high to start with?
Well, certainly during the last decade, those limits were unenforced. The Commodity Futures Modernization Act of 2000 allowed exchanges to self-manage limits, and because exchanges have an interest in generating as many fees as possible, they always found that that the limits were okay. I think the limits before were arguably too high, but what's really changed is the composition of traders, the huge influx of index liquidity bet long to increase prices, and so I think at this point the important thing is to try to reestablish the rule of law and to defend the position limit rule and other rules from a really radical attack by Wall Street, questioning the authority of the CFTC to set these rules. And the CFTC has decided to use the legacy level limits, legacy limit levels, as a way to establish a legal precedent for defense.
All right. Our next question is, I think, for both panelists, and it's a little long, so bear with me. This person says they're very interested to learn of our perspective regarding carbon dioxide, in particular its treatment as a global commodity and by the CFTC. Discuss, as you may know, the EU and US are on a collision course regarding the regulation of airline fleets in the EU emissions trading scheme. So the question is, are there any ideas about whether the WTO dispute resolution mechanism is appropriate to deal with that and what the global implications of that might be? And then secondly, the ECJ, I guess European Court of Justice, has issued a preliminary ruling in support of the EU on this. So is treatment of carbon as a commodity a useful thing to help facilitate global opportunities, or are there some downsides to that? And can anyone speak about environmental markets facilitating carbon credits as opposed to offsetting carbon? So I think that's the question. So regarding carbon markets and carbon as commodity.
Marcus, maybe you should take that one first.
To be honest, the carbon markets are not my best knowledge. So I can only say that in the MiFID and all these regulations that we have seen, the regs and regulations, the emission allowances play a big role. So they will be much more covered than before by these financial markets laws. Also on market abuse, they are included now. On MiFID, they are much more included than before. So the European Union is trying to cover also problems in these markets. However, on this general question and the usefulness of these markets, I cannot really say very much.
The DoddFrank legislation required the CFTC to publish a study on how the forthcoming rules would apply to any carbon emissions market that the U.S. Congress might agree to. And one of the things that the CFTC staff was surprised to find out was just how much opportunity for fraud and market misrepresentation and lack of integrity of physical assets were reported not just by NGOs, but by traders and indeed by the international police organization Interpol, which called carbon offset markets the 21st century white-collar crime. So, you know, there's a huge number of problems with both the market integrity of the derivatives, which form most of the carbon trading, and then of the environmental integrity of the underlying asset. There's a lot of scientific controversy about how permanent and additional carbon sequestration is. Regarding a WTO dispute about levies that the European Commission would level on products, I do know the WTO dispute settlement system. This would be a new area for them, to say the least. I don't think at this point there's going to be a WTO member who's going to build a defense on the provision in the General Agreement on Trade and Tariffs that allows countries to take emergency measures to protect their environment. It'd be very interesting to see if the EU would use that defense, because a very big issue in a dispute would be, okay, we're applying levies to airplane travel. What's next? Are you going to apply levies to imports that are basically suppliers for the European market? So I think it's going to be a very, very complex and difficult case. I think right now the general consensus is that direct investment to reduce greenhouse gases is both more economically and environmentally efficient than going through the very indirect, poorly regulated and highly volatile world of commodity derivatives markets.
Thanks. We have a question on transparency now. There has been discussion in many circles, including food security analysis, about whether excessive speculation is really a problem. So do you think, both of you, that the new transparency requirements will provide enough information to settle that issue? Or will we always have to continue to have some saying that's a problem and others saying there's no proof, as we do today?
I may say, You want to go first?
No, you can go.
Okay, I'm going to I wanted to go first because in the Commodity Exchange Act and also in DoddFrank, there's not a formal legal definition of excessive speculation, except in regards to that amount of liquidity which disrupts markets, which creates disorderly markets. And under the Bush administration, because the position limits were not enforced, and because there were 700 no-action letters basically exempting trading firms from possible violations, it was difficult to see just how large the over-the-counter market was and how those unreported positions would affect volatility. But there are a lot. Marcus has compiled a wonderful bibliography of studies by eminent commodity economists showing a high degree of correlation between over-the-counter positions and commodity volatility, both in terms of the volume of trading, but also in terms of the trading tactics, and especially what is called the index fund role when you're getting in and out of positions, and the weight of over-the-counter trading creates this high degree of volatility that you cannot explain through fundamental factors.
Yeah, to add on this, in general, I think that you will never have the final proof by having certain figures regarding this discussion. The mathematic proofs that you can also get from these data will never be give you a final answer. Just to give you some examples, it might be that having weekly data will also never solve the question in how far the relation is between positions. I met once an economist at the conference of commodities who told me that he thinks that unless you don't know all from every time about the data, you will never be able to make any clear proof, because between the weekly reporting point of time, there can happen so much, and that you would have to cover all this. However, given the data we have and the tests that have been undertaken, there are various means which show correlations, and we cannot do this in the European Union so far, so we will have a higher chance to at least make such tests in the European Union too, which has been only possible so far for the US. The discussion which tests are applicable would take also a long time. For example, if you take the tests like Granger tests to prove anything from the data, even just the application of the test to the data is contested, or how you have to apply the test with kind of delays of effects that you have to take into account for the causality tests. So there's a very long discussion. However, as Steve said, there's a long list of studies which compiles evidence. And I think also that the proof will not only come from the data, but also from more general considerations on commodity markets. A kind of you look for certain signs in the whole discussion which prove your excessive speculation theory, but you will never just have the data and then solve all questions.
There's maybe one thing to add about the apologists for excessive speculation are basically demanding a burden of proof that you would only have for market manipulation. The idea of having position limit surveillance is that you just warn the trader that they've exceeded their limit. It's administrative infraction. You're not pursuing a criminal case or anything like that. You're trying to use a preventative mechanism, a precautionary application, if you will, to prevent the kind of buildups in positions that can result in counterparty defaults if the underlying asset, if the price of the underlying asset changes dramatically. And my belief is that, at least in agricultural commodities and climate change, that there's going to be a high degree of variability in the deliverable supply, which is the basis then for the derivatives position limit rules.
Okay, we have a question on transatlantic cooperation. The speakers refer to independent actions from both the EU and US legislative and regulation perspectives, what does the future look like? How much collaboration is possible between the US and EU on this issue?
Maybe I can start. In general, I think that the European Union looks at what the US is doing. However, we also have realized that there are some effects if the US people pressure too much at the European Union level. For example, if Mr. Geithner is pressuring for regulations in the EU, or Mr. Gensler is pressuring for reforms in the EU, this might also cause a kind of, I don't know how to say this in English exactly, the best word, some kind of counter feeling that you cannot just have all the regulations prescribed by the US, and so they say we have our own approach, and we don't let all the stuff being dictated by the US. This is what we have experienced in several occasions. So this means if there's too much pressure, this might be also counterproductive. However, I think that the EU is looking, and for example, we are also trying to in some respects give the US as an example to the European regulators and lawmakers, because we think there are some promising approaches in this.
I would agree with Marcus. Secretary Geithner has caused a lot of political controversy by making demands about a regulatory system he doesn't understand, and indeed about the constitutional foundations of European communities regulation. So my impression is that there's a very good regulatory cooperation relationship between the CFTC, and the SEC, and the European Commission. At the same time, what they do will also be subject to kind of the G20 framework, and there you have obviously a number of other actors with different interests, and the strategy of those who are opposed to regulation is obviously to try to make the G20 commitments as vague and as ineffective as possible. The danger of this, of course, is that with more self-regulation of markets, with the capital reserve requirements not the Basel capital reserve requirements not going into effect until 2019, there is a tremendous potential for another blow-up, and whether the central banks can again come to the rescue of the private banks is a real open question. So I think I emphasized the need to get commercial hedgers on both sides of the Atlantic involved in these regulatory debates is something that we still need to work on, because a few commercial hedgers were very outspoken. Virgin Airlines, Delta Airlines, Starbucks Coffee, and a whole host of smaller commercial hedgers. But there are a lot of commercial hedgers who like to trade in dark markets and who have as large a financial speculation portfolio as they have a commercial hedging portfolio. So it's going to be a big task to convince them that which favors their private interest poses a systemic risk, and the transatlantic memorandum of understanding that will be negotiated by the CFTC and by the European Commission will have to have some very wide-ranging consultation, and not just the usual consultations with the banks and the exchanges, in order to make this a really effective transatlantic process.
All right, the next question is on thinking about the causes of volatility. It says there is volatility induced by low stocks and uncertain expectations for the future. Do you think that the effect of derivatives trading are independent of this volatility or amplifying of this volatility based on market fundamentals?
Marcus, you want to go first on this?
Okay, I mean this relates, I think, to the question before, if the transparency will solve that excessive speculation discussion. As said, if you look at the fundamentals, you can have different, let's say, reasons to question that the volatility that we see is really to be explained by the fundamentals. For example, you have the discussion in respect to the demand by China, and you can see that many economists also question that this rising demand would justify the volatility. You have the same for the biofuels, which have grown throughout the last 3-4 years, while we had a big slump in 2009 in the prices. And so there's a lot of doubts about the fundamentals being the only force for the volatility. Having said that, I think it's very difficult to exactly say how much of the volatility is now due to speculation. There are some studies which try to assess it and say it's 15%, it's 25%, whatever, and they make this kind of tests by regressions or whatever, and they come to the conclusion that it's so many percent. I'm rather reluctant to give such a figure. I think it's better to make a general assessment, then you can finally say, okay, we can assume that it's one of the main reasons for the volatility and a very important factor, but it's very hard to give the exact extent of the force of the speculation as a reason for volatility.
I think the traditional explanation that speculators only are responding to fundamental factor volatility is an explanation that was valid in the pre-2000 U.S. markets, in the sense that traditional speculators are responding to the fundamentals with a short-term investment horizon. I mean, they're looking at 90-day to 1-year contracts and basically deciding whether the fundamental factors justify the prices in the market or not. With your index investors, such as pension funds and endowments, very large investors looking to diversify their portfolios and to do so maybe with the 30-year horizon that pension funds have for investment. That's a very different kind of world. And when you don't put any limits to the amount of equity that can be injected into a market which is supposed to serve the needs of commercial hedgers, you have the extremely volatile market situation, which is further than fueled by the high-frequency trading that Marcus discussed. And the high-frequency trading is not something that the G20 has tackled. The International Organization of Security Commissions kind of broaches the topic, but with high-frequency trading, you have most of the positions liquidated within the day, and so the traditional use of daily reporting from exchanges is not going to reveal the entire price dynamic in the data field. So I think we're, that traditional explanation, speculators do nothing but respond to, fundamental factor volatility is a pre-2000 applicable explanation, at least in U.S. markets.
All right. I have a follow-up question on high-frequency trading. Marcus mentioned there are certain measures being considered in the European Union to address this problem or this practice. Has that been dealt with in DoddFrank, and are there any ideas that it might happen in the near future?
So under DoddFrank, there's a general framework to deal with trading practices that are disruptive of price formation. And one of the high-frequency trading practices is called spoofing. And what you're doing is basically placing orders with no intention to complete them to try to smoke out what other traders are willing to pay. And I've read one, I don't know if it was a better market study or if it was another study that said for some high-frequency trading practices, spoofing is 90% of the activity. So you have this injection of apparent liquidity, kind of, that becomes a phantom liquidity when the trade is not completed. In any event, it's disruptive to the market, and right now there are. I'm not aware of any specific rulemaking process that will tackle high-frequency trading, but I will note that for what it's worth, traders reported in a Financial Times article that the kind of the MIDI commodity price collapse of May 2011 was driven by exchange-traded funds traded through high-frequency trading algorithms and traded over the counter. So there you have the trifecta of an uncorrelated commodity market price collapse.
All right, we have just a few minutes left, so I'd like to give the speakers a chance for any final comments. And I guess I would urge you at this point to let us know what's on the horizon, either in the US or EU or at the G20 or other international forums to deal with these issues.
Marcus, why don't you go first?
I don't have so much to add. As I've tried to demonstrate, in the EU it will take a long time to really have a final setup of regulations, because you have to keep in mind, even if you have the regulations and the directives in place, it still takes time to have the process which is now going on in the US with the implementation by the authorities. So it will take at least 2 or 3 years till we really have some rules implemented here. And I think that's a big problem which is caused by the European Union lawmaking process. However, I hope, given the things going on, that there will be some rules which are helpful to tackle abuses and speculation in the commodity markets.
First, let me say that in doing this work since 2008, I've been very impressed by the integrity and transparency of the CFTC, and also actually in my meetings with the Commission. One organization that we haven't mentioned here is the UN Conference on Trade and Development, which has really done remarkable analytic work on the financialization of the commodity markets, and furthermore has pointed out that one of the unappreciated factors of extreme commodity price volatility is that it sends the wrong price signals for macroeconomic management at the level of central banks. And so I would anticipate that there's going to be a lot more work on that issue. I agree with Marcus. We're going to see some delays. Part of them will be very legitimate implementation delays due to the fact that the regulatory agencies are trying to get their hands around a market that's developed in semi-secrecy or at least without regulation, that's grown to 7 times the size of the regulated market, and you have a huge multi-$100-million campaign to prevent implementation of DoddFrank, including challenges which will very likely go to the Supreme Court. I'm optimistic that the position limit rule will survive a court challenge. I'm optimistic that other proposed rules will survive a challenge. But even with all that, if the agencies don't deal with high-frequency trading, I'm just wondering how they're going to deal with this data flood in such a way that they can implement the rulemakings. So I'm hopeful, but a bit apprehensive.
All right. Well, thank you, Steve. And I especially want to thank Marcus Hand for his time today. And also, as we close, to direct all of you to our website at www.iatp.org, where you can watch for information about upcoming webinars and where we will post a recording of this webinar within the next couple of weeks. We'll also be sending you a link by email. Thanks to all of you for joining us today.
Thanks.
Thank you.
The